Have you ever wondered what a company really looks like? Behind all the glossy reports and the flashy product launches? Well, today we're going beyond the highlight reel. We're going to put a company right on the x-ray table and learn how to read its financial skeleton, the balance sheet. Okay, so think about it like this. The profit and loss statement, that's kind of like a company's social media feed. It shows you all the best moments, the big sales, the profits, the awesome performance over the last quarter or year. But the balance sheet? That's the doctor's report. It's a single snapshot in time that reveals the company's underlying health, its real structure, and tells you whether all that amazing performance is built on solid rock or just, really good photo editing. And that's really the big idea for this whole explainer. We're going to treat the balance sheet just like a financial x-ray. It lets us see right past the surface to diagnose a company's true strength, its stability, and maybe even spot a few risks hiding there in plain sight. So to start our examination, we have to understand the company's basic anatomy. And you know what? Just like our own bodies, every single business out there is built around one single, non-negotiable skeletal structure. And here it is. This is the whole shebang. Assets equals liabilities plus shareholders' equity. Now, this isn't just some dusty old rule for accountants. It is the fundamental logic of business. And the most important thing to remember is it always has to balance. Always. No exceptions. Let's break that down into simple terms. Assets are all the cool things the company owns. We're talking cash, buildings, patents, all that inventory in the warehouse. Liabilities? Well, that's everything the company owes. The bills it has to pay, the loans it took out, all the IOUs. And shareholders' equity? That's the best part. It's what's left over for the owners once you've paid off all your debts. It's the company's true net worth. And this, right here, is exactly why we care. I mean, this isn't just about making numbers add up for fun. For any investor, this equation is literally the blueprint for a company's resilience. It tells you if a company is built out of solid brick or if it's just a house of cards, ready to get knocked over by the slightest breeze. All right, let's start the checkup, and we'll begin with assets. This is where we measure the company's muscle. But the really big question isn't just how big are the muscles. The question is, are they actually strong and productive, or are they just dead weight? So assets basically come in two main flavors. First, you've got your current assets, things like cash or inventory that you plan on selling pretty soon. Think of this like the cash you have in your wallet right now. Then you've got your non-current assets, like big factories or fancy equipment. These are the long-term tools that are going to help the company make money for years and years to come. And this is absolutely crucial. A giant pile of assets means absolutely nothing if it isn't working hard for the company. I mean, a factory that's just sitting there empty, or a warehouse full of products that nobody wants to buy. That's not a sign of strength. Investors want to see assets that are out there, generating profits. A huge asset base that isn't making money is just a really, really expensive paperweight. Okay, we've checked the muscle. Now it's time for the next part of our checkup, liabilities. If assets are the muscle, you can think of debt as like financial cholesterol. Right? A little bit might be okay, maybe even necessary to grow, but way too much of it can start to clog up the company's arteries and put the whole system under some serious stress. And luckily, we've got a super quick diagnostic tool for this, the debt-to-equity ratio. It's basically a financial blood pressure check. It tells you almost instantly how much a company is relying on borrowed money versus its own money. A really high reading here can be a major red flag that the company is under way too much pressure. And finally, we check on the core of the company's health, shareholders' equity. This is the ultimate measure of its net worth. You can think of this as the company's bone density. It tells you just how solid and resilient it is right from the inside out. So equity comes from two main places. First, there's common stock. That's the money investors put in way back at the beginning. But the really exciting part, for me anyway, is the second piece, retained earnings. These are all the profits the company has made over the years and then decided to reinvest right back into itself. A big, growing pile of retained earnings is a fantastic sign of health. It means the company is strong enough to pay for its own growth. All right, all this theory is great, but let's make it real. It is time to put a company you've definitely heard of on our examination table. Let's slide Alphabet, that's Google's parent company, under our financial x-ray and see what its balance sheet actually tells us. Okay, so here are the simplified numbers from a recent fiscal year. Alphabet has about $450 billion in assets and about $125 billion in liabilities. That leaves a massive $325 billion in shareholders' equity. And remember our equation? 125 plus 325 equals 450. It balances perfectly. Now, this is where the story gets really, really interesting. Just look at how Alphabet's enormous asset base is funded. A whopping 72% of it comes from its own equity, from its own money. Only 28% comes from liabilities or debt. This is the financial equivalent of owning a mansion and having like a tiny, tiny mortgage. It is a position of incredible financial strength. And here it is, that blood pressure check we were talking about. Alphabet's debt-to-equity ratio is just 0.38. What that means is for every single dollar of its own capital, it only owes about 38 cents. That is incredibly low. It is the sign of a very clean bill of health with almost no financial stress on its system. So we've completed our examination. Now it's time for the doctor's final prognosis. Let's wrap up everything we've learned and boil it down to a simple guide so you can spot a healthy company versus one that might be heading for the emergency room. Here's your cheat sheet. On the healthy side, you're looking for equity that's consistently rising, debt that's under control, and a growing pile of cash. The big warning signs? Debt that's growing way faster than sales, profits being wiped out from retained earnings, and cash reserves that are getting smaller and smaller. It's really the difference between an athlete in peak training and someone who's been skipping the gym for a little too long. And this really just brings it all home, doesn't it? The profit and loss statement tells an amazing story about performance, how fast a company can sprint. But the balance sheet, that shows its underlying strength, whether it actually has the stamina and the structure to run the entire marathon. Performance is exciting, for sure, but a strong foundation is what makes it last. So the next time you're looking at a company, don't just get dazzled by the big profit numbers. Pull up that balance sheet, run your own little checkup, and ask the most important question you can ask. Is all their success built on solid ground, or is it a house of cards? Now you have the tools to find out.